Hi, and welcome to this week's look at the major news stories that have affected the market so far and what's likely to rumble on for a little while. And we're going to start with the FTSE 100 on a bit of a decline after the inflation data out in the UK. Now, CPI, that's the sort of main measure used for inflation, actually came in at 8.7% annually. It was forecast to drop to 8.4% from the last reading of 8.7%, but unfortunately remained the same, which, as you can imagine, caused a little bit of furore. In fact, core CPI, now that's the figure that excludes food, energy, tobacco and alcohol, actually increased to 7.1% annual compared to a forecast of 6.8% and a previous of 6.8%. That's the highest core rate since 1992 and was a little bit of a shock to the markets, it's got to be said. This worryingly persistent inflation is definitely becoming an issue. We've got a Bank of England interest rate decision due out just very shortly today, Thursday. And in fact, now people are talking after these figures of a potential 0.5% increase, which would give us some seriously high interest rates, sort of likes of what we've not seen for 15 years. It comes with some risk, though, and some criticism of the Bank of England's continuation of using interest rates for everything. Commentators, including CNBC, for example, are saying that further increases are fraught with risk of a development of a mortgage crisis. Obviously, rates going up, people have got to pay more on their mortgages, simple as that. Now, the chart shows the negative dynamics within the FTSE, falling yesterday, it's Wednesday, sharply to the psychological level of 7,500. This all happened after testing 7,680, which was previously support, but now quite clearly resisting growth. Now, as I say, this is before the rate announcement comes out, so we're currently around the 7,495 points, so below that 7,500 psychological level. I mean, could the bears attack, particularly if we see a big rate rise and force it down to the lower line of the descending channel, which is shown in red? It's going to be a tricky few days. There's going to be volatility out there, that's for sure, so don't forget your risk management techniques. Okay, so we're taking a quick look at the FTSE and not having the best of weeks, that's for sure. But what's next for the pound? We've reached one-year high, so it does beg the question, what's going to happen next? Clearly, the long-term lack of volatility has got well and truly gone. The last 12 months have shown that. I mean, the last quarter of 2022, the pound declined consistently versus US dollar. We've covered it a number of times. Brexit, lockdowns, etc. But doom and gloom abounded at the last part of last year. No questions asked. But now, in the middle of 2023, it looks like sterling, the great British pound, has turned its forecasts around, starting this week at a one-year high versus the US dollar. In fact, in the 1 week to the start of this week, it went from 1.25 to 1.28 pounds to the US dollar. Just a few years ago, that would have made seriously headline news, a 3-cent move, but we seem to be getting used to it. The upward direction's been pretty consistent, and we're still currently, again, pre this Bank of England figure coming out shortly, we're still currently the highs of 127, so it seems to be holding these gains. There was no large pullback on the CPI data, so what happens with an interest rate decision, nobody's quite sure, but it's probably going to have some sort of impact, that's fair to say. You know, an increase in interest rate, as we've mentioned, direct impact on consumers with mortgages, debts, etc. And it may well cause a refocus on living costs. That may well be the major impact, which could cause a lack of interest in these markets for a period of time. But the interest rate will also may also give us a little bit of colour of what's going to happen. Whether this is going to be a sustainable high and we're going to see it push on, or is this just a result of the increased volatility we've been seeing lately and it's going to be short-lived? Whatever happens, I think there's going to be quite a lot of moves out there. Again, this volatility in an age-old pair has definitely been increasing, and I don't really see that changing. So, not to sound like a broken record, do not forget your risk management techniques. Okay, a little move away from the UK now, and dollar yen is at the high of the year, or certainly has been. Now this week we saw the yen weaken to 142.25 versus the US dollar. That's the first time we've seen that level since November 2022. Now, quite honestly, what is causing this? What's happening? Well, it's no surprise. The difference in monetary policies between the two countries. Obviously, the Fed been raising rates. Although we have paused, they have stated there may well be further increases this year, whilst the Japanese have taken a very soft approach on interest rates, which obviously is quite a big diversion. Now the chart shows here that the rate is moving within the long-term ascending channel that's shown in blue, near the median line now, which can serve as resistance to slow down the rate of growth or even promote a pullback within the channel that's shown in yellow. Now, however, we talk about a pullback or a bit of resistance. We have seen a series of higher lows that has been going on since March of this year. Now, that suggests that bulls are trying to dominate this market and may well be trying to break that median line. So again, the strength in the dollar against the yen, that's for sure. This discrepancy or the difference, divergence between their monetary policies comes to play. So always keep your eye on for news on that. Is Japan going to take a slightly different tack? That could have an effect. But again, keep your eyes and your ears to the ground. Okay, so we're going to finish off, like as we often do, having a look at an individual equity, a share. It's Intel Corporation. Their shares are up just 16% in 1 week. That's quite a big movement for something which has pretty much underperformed the tech sector for a number of years. And a lot of people say it's about equipment obsolescence and a lack of innovation from the company itself. So why the sudden change? That's a pretty sharp move, I think it's fair to say. In fact, last week was its best week since July 2009. What's happened? Well, it's all to do with the hype around AI. There's market rumours of a new processor they're working on that shows good results training neural networks for AI. Now, we've touched on AI before in these videos. It is the hot topic of the moment. There's also their acquisition of chipmaker Habana Labs Gaudi. Now, a lot of analysts saying this is going to give them an edge again in terms of chip manufacturing, particularly if they're going to focus on AI. Now, the chart shows that the price bounced off the lower end of the long-term up channel after hovering between $25 to $30 for some time. Now, people are saying that was an accumulation range, big investment firms building an investment position. That's obviously been broken out of now. And there's a lot of belief that $30 could well act as support. Now, on the other hand, in terms of preventing or stopping a further rise, there was a really strong level of $42.50, which stems back from 2018, the share price back then, which could provide resistance for a major significant move forwards. Worth noting that this week it has given back some of those gains. We're looking at close yesterday about 32.90, so he's back quite significantly, but obviously we're still up on where it was a couple of weeks ago. In fact, last Friday, a Morgan Stanley analyst raised the price target for Intel Corporation from $31, which was still above, which is great, to $38. So there certainly seems to be plenty of sentiment in the market that Intel could capitalise on its new innovations and push forward in a way we haven't seen it do for some years. But as ever, speculation and rumour such as this leads to volatility. So be careful. Stop losses are your friend. Have a great week and good luck with your trading. Bye for now.